You can see there, call made for bigger wall on Wall Street. This is at the top of Money Investing, the C1 section. This is very interesting. Everyone knows about the wall between analysts and stock sellers in Wall Street firms. Why am I having trouble explaining this, Gene Eaglesham? But the debt offerings is where there is no wall, and that's what we're talking about right now with Gene Eaglesham, who wrote this story. It's very interesting because there is this sort of Chinese wall between stock analysts and the stock sellers within firms, but the same wall doesn't exist on the debt side. Is that what's going on here?
It's exactly it. It's emerged as this very big loophole, really. There's this, almost 10 years ago, the regulators forced all the big Wall Street firms to put in place these firewalls. And the aim was to stop the sales and trading staff from influencing the research staff, and it was from this concern that research staff were being...
Well, because it had happened.
Well, yeah, exactly.
We saw it, right?
It happened in the tech boom, exactly.
Right.
The research staff, the analysts were puffing up these stocks that then collapsed. They were doing it to help the investment bankers win business, underwriting IPOs and so on. So regulators came in and said, no, that's not right. We're going to put in place these very strict protections. The two sides have to be separated. The research is independent, and it's not being driven by the sales and trading
but that
people.
doesn't exist on the debt side.
Exactly. Now, all these very big, debt market, which is actually bigger debt offerings, much bigger.
Right, you can see the little graphic there. Pretty stark terms.
Exactly.
25 trillion in debt, 2 trillion in stock. But this wall does not exist.
The debt analysts were left out of the regulations, and that's already caused problems. We saw with these investments called auction rate securities, which is a market that was sold very hard and then froze in the credit crunch. And there were cases brought then, particularly by state regulators, other regulators, where the firms had allegedly used the debt analysts to put out research to reassure investors. And in case of one firm actually force the analyst to rewrite a report that was pointing out some of the risks of these investments.
Who was that firm?
That firm was Merrill's, which is now part of Bank of America, but they settle the allegations without admitting or denying liability.
Right, like they always do.
All the firms settle these, settle these cases. But it was a very good illustration of how, in this case, the research analysts were being lent on to reassure investors to keep the business going. So now we have FINRA, which is one of these regulators.
Right. That's the industry self-regulator, right?
The industry
it's not a government watchdog.
Exactly. And it is proposed this rule that would put in place protections, again, between the debt analysts and the sales tribe.
Now that kind of expand what is already there.
Exactly.
My question is, why now? Why is this happening right now? Is there anything that has sparked this?
Well, FINRA's been, thinking about this for quite a while. The rule has to go to the Securities and Exchange Commission to be approved, so it has taken quite a long while. And really, the concerns about the auction rate securities now were, 3-4 years ago. So it's taken a long while. It's a slow process, but there's people saying now is the time to act. And I think, with the concerns around the Facebook IPO, that's obviously a stock issue. It's not a debt issue, but I think certainly people on the consumer side are saying, look, we need all the measures we can to restore faith in market integrity. This is a good example of that. Let's get this rule passed.